Okay. Hey, everybody. Welcome. Thanks for joining in. This is Rob Cowan. Thank you for coming by. We're going to talk today about the banking situation that started off maybe out on the West Coast, then went to New York. Anyway, who we have with us is Mitch Sanford, president of Builtwell Bank, and banking expert. So I'm going to ask Mitch a bunch of questions. Hopefully that will educate me and educate you at the same time and give us a little more confidence about what's happening here in our community. So Mitch, welcome.
Thank you, Rob.
A couple questions.
Sure.
First off, if you can kind of tell me what, in general terms, what happened with the banks in Silicon Valley Bank and Credit Suisse and all that we've been reading about.
Yeah.
What's going on?
You know, each bank that I have read about a bit so far that's had issues, it has not been the same, okay? But there probably is a common thread that's caused some of their problems. And believe it or not, that common thread is similar to we all are experiencing in the fact that interest rates are much higher, not just a little higher, much higher today than they were just 12 months ago. And those higher interest rates have changed some of the things that we as bankers do to manage our business every day. And as with any business, some people do it better than others, right? And so again, I'm not overemphasizing to say the large increases in rates, which are unprecedented for this short amount of span of time, 12 months, have made things more difficult.
Explain that to me in relation to Silicon Valley Bank, where we have this impression that they just extended loans to people that they should not have done.
Great, that's a great question to clarify. So let me go back to our most recent economic recession back in 2008, right? The Great Recession, as we all refer to it now. That banking crisis, if you want to use that term, was definitely driven by problem loans, okay? Without question. And we don't have time to dig into why is what, but right, that was the crux of that banking problem then, okay? That's not the case today. Believe it or not, as we sit here today, from a loan perspective, probably, you know, in my 30 plus years in banking, our loan credit quality today is
at Silicon Valley.
Okay, so I'm going to try to, as best I can, and you stop me and redirect me if I get too banking and use too many banking terms on me, okay?
I've been told that I sometimes talk too much like a lawyer, so
okay.
I'll help.
You know what I mean?
Yes.
All right. So here's the simplest explanation of what banks do is we have customers, depositors, right? That loan us, if you will. I'm going to use that term. Loan us your money, right? You're gracious enough to put it in our bank, and there's a portion of that money that we loan back out, right? To borrowing customers,
right?
Okay. Now, there's always a portion of that deposit base of customers that we don't loan out, right? And not every bank's the same. Everybody's model's a little different. But you, as a community bank, our primary goal is to take those local customers, our customers in our communities, and loan it right back out into that community, right? And support that community.
Yeah.
Now the larger banks, who are all over the country, they probably are not as focused on that as we are.
So in comparison to Builtwell, where you are, Silicon Valley, about the same size?
Oh, no. Silicon Valley was either the 16th or 17th largest bank in the country. They were $100 billion.
And Signature Bank?
Signature was a little over $100 billion.
Okay.
And built well, we're just shy of $2 billion.
Okay.
So
So you're a true community bank.
Yes, no
Okay.
question about it.
All
So
right.
so here was Silicon Valley. So they had a couple of issues that got them to where they were. So first of all, they had some extremely large deposit customers,
Okay.
right? And so when I say extremely large, I'm talking about hundreds of millions of dollars to one customer. And you could look at that, that coin is two sides, right? You could look at it and go, that's great that large customer has got their money here with us. But the downside of that, which is something that every banker has to manage, and that is, what if, just remember, as a depositor, you're loaning me that money.
Okay.
Because you can come get it anytime you want to, right? Anytime you want to. So that large deposit customer decides, for whatever reason, I want all or a large portion of my money. Well, you've got to be ready to give that to them. If you cannot give that to them, then the snowball effect of that is bad, is very bad, right? And so that was one of the problems that Silicon Valley Bank had.
Okay.
They had some extremely large, extraordinarily large customers who had large deposit accounts with them. So when funds started leaving the bank, they didn't leave $1,000 at a time. They left hundreds of millions of dollars at a time. To the point that I'm sure you read the same thing I did. In one day, there was a request, like a day or the day before they actually were closed, $42 billion of monies to be pulled out of that bank in one day. And so that is almost impossible to manage.
And the reason, we don't know the reason why those depositors, those deposit customers wanted their money, or
From what I have read, Rob, that there was probably some legitimate information out there that there was some problems or some issues they were having to work with. And again, listen, I read just the same information. I won't call any companies' names, but one company in particular that's public knowledge out there had almost $500 million in that one company's account. And if I had that much money in any bank, and I heard a rumor that things might not be good, I'm going to look around and go, that's only insured for $250,000.
right?
I probably should do something. And a lot of people had that same thought.
All at the same.
All at the same time.
Okay.
That's right. That's right.
So when we think about this, what role does consumer confidence play in what we're seeing and the reaction that we're seeing
Yes.
from the regulators and from the banking industry?
Yeah. That's another one of those loaded questions that I could ramble on for too long about. But
I won't let you.
yeah, thank you. Yeah, but look, I would tell you, I read this today, and I think this is a true statement. We really don't have a widespread financial crisis like we had back in 2008 through 10, let's say.
Okay.
We do have a bit of a confidence crisis, if you will, right this moment. And I don't think that is because there is a widespread issue. Listen, I think there's a lot of uncertainty out there for all of us today, right? And it's not just in one area. We've got geopolitical issues, used to what happened, on the other side of the world was just news we watched. It really didn't affect us very much daily. That's not true anymore. There are some ripple effects on things like that today. I've made this statement several times. I remember 20 years ago when the term global economy started being thrown out. And and back then I would go, oh yeah, okay. Well, but today that's really true.
Right.
That's really true. And so those geopolitical issues that are out there today brings uncertainty. Inflation at levels that you and I really, as working adults, have never seen in our lifetimes. I think it was out there when we were very young, but we weren't having to work and pay bills back then, right? So that's another big uncertainty of the things that's caused, right? And again, I alluded to it earlier. Interest rates now have on just home mortgages, for instance, have pretty much doubled in 12 months. So you've just got a lot of factors out there pulling on you and I, and where are things going, and what's safe and what's not safe. And so this little bubble up here that happened in Silicon Valley and some of the other ones, now all of a sudden, that's another shock, another bit of uncertainty, and now we're kind of scrambling a bit.
So in general terms, what I think I'm hearing you say is there isn't a panic. There's no reason to go to your bank, whether it's Builtwell Bank or it's some other bank in town, and withdraw your money and put it under the mattress.
But matter of fact, do not put it under your mattress, right? Listen, the FDIC insurance is as solid as it ever has been.
Explain to me what you mean by what's FDIC insurance?
Okay, so back in the 30s, and maybe actually even a little before that, this banking crisis was very real before the FDIC, and so you had a little bank pop up in a little town, and again it was local depositors, they were loaning it out locally, but there was no overarching assurances that if that banker made bad choices, you could literally lose your money, and not as an investor, as just a depositor in that bank.
Okay.
So the federal government said, you know what, we need to bring some level of assurance up to an amount of some number that you're going to feel comfortable knowing that if your banker does not make good, sound business decisions, you're not going to lose your deposit money because of their poor business choices, right?
Okay.
And the FDIC insurance came about.
All right. And who funds the FDIC insurance?
Banks fund that.
Okay, that's a good point.
That's right. Banks fund that. We pay an insurance fee,
right,
assessed into the FDIC insurance.
So taxpayers don't pay that.
Taxpayers do not pay that.
All right.
No.
And so how much is that right now? How much is my money insured in the bank?
Okay. The short answer is $250,000
per depositor.
Per depositor, and that can get very detailed also, right? Because an account in your name is a depositor. Account in your son's name is a separate limit.
Okay.
A deposit account in you and your daughter's name is a separate limit, right?
Okay.
Your business account is a separate limit, right? So just because your name's attached to it, don't mean it's $250 for everything that's got your name on it.
Okay.
Again, the total can be millions of dollars, and each one of them had that $250,000 insurance.
Okay, and that's for big banks. That's for community banks. That's for everything in between, regional banks.
It is just one of those when we do any kind of advertising, print, radio, whatever. You're always going to see a little tagline or hear it, FDIC. Make sure it's that. Now, I'm not aware of any banks, especially around here, that are not FDIC insured.
Okay.
But technically you could have one, but I don't know if there's any.
Okay.
Right, yeah.
All right. So do you want to talk about how the Fed and the large banks are responding to what's happening in these, what it sounds like you would describe as kind of isolated situations?
Yeah, I think, look, the situation with the Silicon Valley and Signature that was up in New York. Again, there was...
And then there's a First Republic.
First Republic
already brought a bunch of money in.
Yeah, they have. They've not been closed. They're still out there. And from what I have read, the underlying underpinnings of that bank is not bad.
First Republic?
First Republic,
Okay.
yeah.
I don't mean to. I asked you the question, and then I all of a sudden added something, and I don't want us to chase
Yeah,
that
yeah.
rabbit for a second.
But there's some similarities in First Republic to Silicon Valley in that they've got some very large depositors that well exceed that FDIC insurance. And again, just remember, if your loans are good, so there's no problem financially with the bank because of bad loans, but if all of a sudden, hundreds of millions of dollars of your depositors decide to take their money,
Yeah.
that is we've all heard that term, run on the bank, right? And that's basically what can happen. And so it turns out to be a crisis for that bank when there may or may not really be underlying one, right? And I do think that the fact from a communication standpoint, the social media and the immediate news that's out there today, makes information go around quick, good and bad. It gets out there very quickly.
Yeah.
And so it's a situation where I think, again, it's isolated, but again, panic, and when folks start making decisions that aren't based on any factual issue, then that's where problems come in. But
Emotion,
right?
Yeah,
there you go. Yeah.
So are the big banks doing anything different than what Builtwell's doing in this situation?
No.
And so is the FDIC creating additional stress tests or anything like that for the banks as a result of what's happening?
I've not heard of any that they have changed or doing just in the last couple of weeks, since this popped up. The regulatory bodies expect the senior folks running any bank, large or small, to manage those risks, right? And again, when you have just incredibly large depositors like we referenced, you put yourself at a larger risk. Again, should they want those funds in a hurry? For good reasons or bad reasons, it doesn't matter. You've just got to plan for that kind of thing, and that's what the folks at Silicon Valley Bank did not plan for.
Gotcha.
It's timing of things. So again, if I've taken those excess deposits in that I've not loaned out, and I put them in safe investments. When I say safe investments, I'm talking about U.S. Treasuries, right?
Right.
Backed by full faith and confidence of the U.S. government, right?
Right.
So the underlying investment itself, there's nothing wrong with it. But if I've got to go sell it now because you and a bunch of other people want all your money or a large part of your money, it's like with anything. The worst time to sell something is when you have to sell something, right? The best time to sell it is when you don't have to sell it. Well, they started having all these outflows of deposits. And again, I don't want to get too complicated, but I alluded to earlier, about the rapid increase in rates in the last 12 months. So this can be confusing to even folks like myself who work in the financial world every day, but bond values, so like a treasury bond values work backwards. And here's what I mean. You understand what I'm talking about?
Yeah, but you're starting to lose me. So if
I
you're
know.
losing
I know.
me,
I'm afraid of that.
You may lose Itziana back there,
I know.
and I'm just gonna. I hate to do that, right?
Yeah.
Because you're educating, but I'm just telling you, you're gonna lose
I know.
me a little bit.
But that,
It's important to
but
understand.
that piece is very important
So
to what happened to
explain
Silicon
this.
Valley Bank. Okay.
Okay.
So those excess deposits, or a large portion of those excess deposits that they haven't loaned out,
Okay.
they put into investments in U.S. Treasuries. Okay. So you go back 12 to 18 months ago, and the rate of interest that those treasuries were paying you were just for example purposes, let's just say 1%. Okay, just for some nice easy math. All right, so when that bond is issued, let's just use some easy math, right? That bond is issued for $1,000 bond, and that bond says on it that it's going to pay 1% interest.
Okay.
Okay?
Right.
For how long? 10 years, 20 years, however long the bond is for, right? All right, so you bought that $1,000 bond that's going to pay you 1% 12 months ago. Okay, rates have dramatically increased. And today, that same bond to be issued today is paying 4.5%. Okay, so you decide, you know what, I want to get my money back because I want to do something else with it, whatever that is.
Okay.
Just remember, you have a $1,000 bond that's only paying you 1%.
Right.
The market today says 4%.
Okay.
So there's the only way, and I want to buy it, but I don't want to buy it at 1%. I want market rate. I want my return to be 4%.
Right.
But remember, what the bond pays, that $100, 1% of $1,000, right? Or is it?
That's
$10. $10. $10. I'm sorry. That $10, that never changes. That never changes.
Unless I have it at 4.5.
No, again, we're going on the premise that this bond you bought 12 months ago,
It's still in place.
still in place. It's only paying you $10 a year today. But the market today on new ones is going to pay me $40 for that same $1,000 bond, right? So the only way for you to sell your bond to me and me get a market rate that I want is for you to sell it to me less than $1,000, for less than $1,000. You see what I'm getting at? Because remember, the $10 never changes. That check from the U.S. government for that bond is only going to ever be $10. So you kind of reverse the math there. So what can I afford to pay you for your bond, knowing I'm only going to get $10 that yields me 4%? It's not $1,000, is it?
Nope.
It's way less than $1,000, right?
Yep.
So now the value of your $1,000 bond is not $1,000 anymore. Follow?
Yep.
Not $1,000 anymore.
So are all banks in that same briar patch?
If you're holding U.S. Treasury bonds like I described, and you bought them again 12 months or longer ago, you're in that same position that we just made that crude example to describe. Okay. And so just remember though, we've all heard this term, there's no loss until you sell it, right? And so if you didn't ever sell that $1,000 bond, it's still worth $1,000 to you because you're getting your $10 every year. Only when you go to sell it. And when's the worst time to sell it? When you need to sell it.
Right.
And see, that's what rates have done, and that's what Silicon Valley Bank found themselves in. They had all these folks wanting to take their money out, and the first thing they did was look at their investment portfolio and said, okay, we got to turn it into cash.
Gotcha.
We don't want to, but we got to, because folks want their money. And they had to sell it at the absolute worst time.
All right. So that's a great explanation. The foundation of this issue.
Yes.
All right. Last week we got a lot of calls here from our business clients, right?
Sure. Yeah.
And I say a lot. We had a dozen or so from business clients. It's like, well, what do you think about what's going on? What do I need to do different?
Yeah.
Is it going to be harder for me? I've got this project, on the draft board that I want to do, last 6 months of this year. Am I going to be able to borrow money from a bank in town or whatever?
Sure.
So what I heard you already say is, hey, we've got you FDIC insured. You don't think that this is a systematic problem or issue.
Yeah.
You don't believe it is, so that depositors shouldn't be concerned. What about those like my client who called me and said, hey, I've got this project going. You've signed all these created all these contracts for me, and we're moving forward.
Sure.
What do you have to say to those people about the availability of funds or the ease at which you're going to be loaning money?
Sure. Well, listen, it's one of those things where I would say if it's a good sound project and the numbers worked, last month and same project, there's not been a significant enough change economically to say that should still be a viable project, right? Now, again, every bank's a little different, so I could tell you, I would just say this from a blanket statement being, again, if the numbers worked 12 or a month ago, the project should still be very viable and bankable today.
Good.
Right?
Okay.
Now, but it's one of those things, Rob, that again, this uncertainty that we talked about very early on, coming from multiple places, multiple issues, if we're not careful, we will start down this road, and we will turn something that maybe today is not an economic issue, that we may find ourselves in 6 to 12 months having an economic issue, right? Okay. But the way I would answer your client's question is, again, if 30 days ago that was a viable project, today it still is. Now, I wouldn't make any promises to anybody 6 months from now, though, right? I mean, I got no crystal ball.
Right.
Yeah.
Okay.
Yeah.
Good. Is there anything we didn't touch about this? Anything you thought that maybe, hey, Rob, you didn't ask me this. I'd just like to make sure people hear this.
Listen, one thing that I would tell you, I would tell anyone that asked, and this is, you should know your bank, right? You really should. I mean, whether it's a large bank or a community bank like Built Well, you should know your bank and you should know your banker. And I know for some segment of the population today, that's probably not been a thought, only because they do most of their banking on their phone or online in some shape, form, or fashion. And listen, I use those services myself. So I want you to know, I'm not saying that's a bad thing, but I'm telling you that doesn't replace what I believe is the most important thing about the relationship, your banking relationship, and that is knowing your banker, right? So that you can ask them these kind of questions. And you don't have to read about it in the newspaper. Those relationships are very important, whether you're in business or personally. So I'll just tell you, if you don't know your banker, get to know them. And if you can't get to know them, find you a bank where you can get to know your banker. Really, I think that's sound for all of us, right?
All right, good.
Yeah.
Well, I appreciate you coming by today.
Thank you. Enjoyed it.
I hope this quells a lot of folks' nerves about this situation, and it spreads the word well. So I really appreciate it.
One quick thing.
Sure.
We talked a while ago about the FDIC insurance. And so I wouldn't want anyone to interpret anything I said to say, well, Mitch says I shouldn't worry about making sure my deposits are insured. I'm not saying that, okay?
Okay.
I'm saying there's multiple ways to get that FDIC insurance, but I would never tell anyone whether things are great or economically or things aren't economically great. Again, you need to make good, sound decisions with your money. Make sure you talk to your banker. If the FDIC insurance is a concern for you, please reach out to them and have them help you take care of that. Right?
Okay.
Yeah.
Great.
Okay.
Hey, I appreciate you coming by.
Thank you, buddy.
Again, Mitch Sanford from Built Well Bank. This is Rob. Thanks for coming by. We'll see you guys later. Thank you.